The principal residence exemption is a powerful tax-saving provision in the Canadian Income Tax Act that allows you to shelter the gain on the sale of your principal residence from income taxes. For people who own multiple properties, though, there are some unique opportunities with the principal residence exemption that are often misunderstood. In this video, I'm going to talk about what the principal residence exemption is, and I'm going to talk about how you can strategically apply the principal residence exemption when you own multiple properties in order to potentially save you thousands of dollars of income taxes. And if we haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. And I created this channel to share ideas and concepts that I'm using to help people with retirement every day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so you're alerted when new videos are posted. I'm going to go ahead and share my screen, and we're going to walk through a hypothetical client couple example. They own both a home and a cottage. The home is worth $1.25 million. The cottage is worth $1.5 million. They bought their house in 2006. They bought their cottage in 2012, and they plan to sell both properties in 2024. So they have significant capital gains on both properties, and they've gone to their planner and said, how do we approach this from a tax planning perspective? Their assumption going in is that they have to use the principal residence exemption on the house, their home, and that they would have a significant tax bill to pay on the cottage. And their planner walks them through the principal residence exemption and shows them that there might be some things that they can do to apply that rule and help save them some taxes. So before we jump into the example in detail, I'm going to introduce what the principal residence exemption is. So I've highlighted a couple terms, but basically the exemption allows you to shelter the gain on a house that you ordinarily inhabit and that you own from income taxes. And there's a couple things that do get people tripped up here, and I've highlighted them in bold. First is any housing unit. So it can be the house that you live in week to week that you commute to work from. It can also be your cottage. It could be a condominium. It could be a property that you own in another country, as long as you ordinarily inhabit it. And that means that you are there on some sort of a semi-regular basis. It doesn't need to be the house you live in week to week when you go to work. If you go to your cottage 3 weeks out of the summer or 6 weekends during the year, that would pass the test of ordinarily inhabit. So you have the potential to use the principal residence exemption strategically to maximize its use for your situation. A few other points on the exemption. It includes the building plus about 1.25 acres. So if you own a property that has a lot of land around it, there might be an income tax implication of the sale of the land, even though the house and the 1.25 acres around the house are exempt from taxes. Only one home per calendar year can be designated as the principal residence for the exemption, and we're going to talk about that as we move through the example. The taxpayer must be a resident of Canada to avail themselves to the principal residence exemption. And the way that the formula works in terms of calculating how much of a capital gain can be sheltered from taxes is as follows. It's 1 plus the number of years that you're designating the property as your principal residence divided by the number of years owned multiplied by the gain. Now we're going to walk through the example, so you'll see this kind of in action. But I'll answer the question first. What is it with the 1 plus rule? Because this does come up from time to time. The 1 plus rule is meant to protect the following taxpayer. Somebody who purchases a home, let's say in the year 2000. They sell that home in 2010. In 2010, they also purchase a new home that they own until this day, and now they're planning to sell it. In that year 2010, they owned 2 properties, so they wanted to add a +1 to the formula so that the taxpayer wouldn't be hit with a capital gain in that partial year 2010 where they owned 2 properties. So that +1 rule is meant to sort of protect that, we'll call it like a shoulder year where they own 2 properties. And now as we move through the example, I'll illustrate how the +1 rule can be used strategically in the case of our hypothetical couple. So we're now going to move through our example. And whenever figuring out how to strategically use the principal residence exemption, I find it always helpful to sort of draw a timeline. So this is the timeline we're drawing here. The house, recall, was purchased in 2006, and it's going to be sold next year. So it'll be owned for a total of 19 calendar years. The purchase price of the home, recall, was $350,000, and we plan to sell it for $1.25 million. And when we divide that gain over 19 years, that works out to a gain of $47,368.42 of gain per year. Now look at the cottage, purchased in 2012, and the current value is $1.5 million. The total value of the purchase price and capital improvements is $750,000. And when we divide that over 13 years that we've owned the property, it works out to a gain per year of $57,692.31. Now recall that in the previous slide, you can nominate 1 property per year for the principal residence exemption. And it doesn't have to be the same property. So from a strategic standpoint, if we look at the two properties, we can see that there's more gain per year on the cottage. So what we're going to want to do is maximize the number of years that we claim the principal residence exemption on the cottage. So we'll claim the principal residence exemption on the cottage from 2012 through 2024, which means that there will be a tax bill that is owing on the sale of the house. Now, the good news is that there are years between 2006 and 2012 that you can also use the principal residence exemption because you didn't own the cottage at that time. So there is going to be some gain that can be exempt from taxes on the house, but we're going to want to maximize the principal residence exemption on the sale of the cottage. Now, as we move through the rest of the example, I'm going to show you how we apply these numbers. Now, the next two slides do have a lot of numbers in them. I'm going to step through them quickly, but if you want to read the numbers, definitely pause the video and you can sort of look at how I built it out. I want to move through it quickly because one of the hallmarks of my videos is moving fast to sort of maximize your time. But again, I put all the detail in there in case you do want to check out how the math works out. So this is sort of option one. This is, to me, the ideal option. They're going to split the gain between the two properties. They're going to use the principal residence exemption to cancel out the entire gain on the cottage. So you can see the formula in action at the bottom. In order to zero out or fully shelter the capital gain on the sale of the cottage, we need to nominate or designate that property for 12 years out of the 13 years owned. When we add the +1 rule, that means that we can zero out or fully shelter the gain on the sale of the cottage by using the principal residence exemption over that time period. There still is some years available that we can use the principal residence exemption on the sale of the house. So it's 7 years, and when we add the +1 rule, divided by the 19 years total owning the house and multiply that by the capital gain, that means that $378,000 out of that $900,000 gain can be exempt from taxes. And I put the tax calculation in here, but at the end of the day, on sale proceeds of $2,750,000, I estimate that if this hypothetical couple each already had about $75,000 of income in the year that they sold both properties, the impact of the property sales would result in about an additional $110,904.16 in taxes on the sale of those two properties. And to me, this is the ideal of the two alternatives. In the second alternative, the taxpayer didn't speak with their planner and their accountant didn't pick up on this. They decided they're just going to use the entire principal residence exemption on the sale of the house. And they're not going to maximize its use on the sale of the cottage, even though the cottage had a higher per year gain. Now, as you can see, when we move to option 2, using the principal residence exemption only on the house, the taxpayer was able to zero out the entire gain on the house by using 18 out of the 19 years owned to shelter the entire capital gain. When it comes to sheltering gains on the sale of the cottage, they were able to use 1 out of the 13 years owned. And when you factor in the +1 rule and multiply it by the gain, there's about $115,384.62 of that capital gain that could be sheltered by the principal residence exemption. But when you work it all out, it results in a total taxes payable of $138,749.66 compared to the previous example, or option 1. This option, option 2, would result in them needing to pay an additional $27,845.50. Or said differently, by strategically using the principal residence exemption, the taxpayer would be able to save about $27,845.50 of income taxes. So we'll close with some final thoughts. The first one is no decisions on the principal residence exemption and which property you're going to nominate need to be made until you're filing taxes the year that a property is sold. And sometimes people do get wrapped up around this. They think that they need to proactively nominate the property that they're going to designate as their principal residence or primary residence for tax purposes. That doesn't need to be done until you actually made the decision to sell and then go to file your taxes the following spring. The second one is keep photos and receipts for capital improvements. Recall that in our example, the cottage example, the total value of the purchase price plus capital improvements was $750,000. So we'll assume for our example that they put a new roof on the property, they changed some interior structures of the property, they put a new deck on the home or on the cottage. It's a good idea to hold on to those receipts and take photographs before and after of the work that's being done in case the CRA ever comes back and decides to audit your claim for the principal residence exemption or your tax filing. The second one is filing the correct tax form. Since 2016, the reporting requirements for the sale of principal residences has gone up. So I've noted a couple of things that you need to do on your tax return here. You need to account for the capital gain on your Schedule 3 and also fill out a form called the T2091. Make sure you speak with your tax professional if you do sell a property this tax year to make sure that they're putting the appropriate forms in place. And then finally, the property must be primarily for personal use to be eligible. So if the cottage property that you would like to claim the principal residence exemption against is strictly an income property, that would not be a situation where you could use the principal residence exemption. By and large, if the property is for your own enjoyment, your own personal use, you should be okay to use the principal residence exemption. But as always, speak with your tax preparer, your tax professional, your financial planner before making any assumptions in this case. And finally, if you're considering the sale of a property, either your home or your cottage, think about reaching out to your financial planner and to your accountant to make sure that you're getting the most from the principal residence exemption when you go to file your income taxes. Thanks for watching this video all the way to the end. If you have any questions or comments, please leave them below. If you like this video, consider giving it a thumbs up, and I'll speak with you soon. Take care.